Hi there, and welcome back. As seen in this graph, the abnormal growth of the U.S. housing market has been on an upward trend since 2012, and that trend got even more momentum since 2020. This new, more intense increase in housing prices went on for 26 straight months. What did it mean? Higher prices for home buyers and more profits for the sellers. Is this new trend a sustainable situation or simply another housing market bubble that's about to burst? Join us today as we take a look at the current housing market situation in the country. The Case-Shiller Index is a widely used and trusted measure of the housing market's health in the United States. While some experts argue that the index may be lagging because it uses data that is 2 to 3 months old, others contend that it still provides valuable information about the direction of the housing market. Same is the case here. We can clearly see a drop in housing prices starting in July of last year, and that trend is still on. This massive drop has occurred after an almost 45% price increase from the spring of 2020. As the prices went higher and higher, some believe that's now a really high price and could not go any higher. But to prove everybody wrong, the market soared even higher, making prospective home buyers lose more hope of owning a home one day. And that's not all. Some cities in the country saw an even greater and out-of-range prices. For example, if we compare the price index of Seattle with the National Home Price Index, home prices peaked even before in Seattle. The climb was steeper and reached a top figure of 414 in May of 2022, while the National Price Index peaked in June at 308. Similarly, the price drop is even more intense in Seattle and has dropped 63 points, while the national index is down just 14 points. What does this show us? It shows some areas are hard-hit areas and display a stronger effect of the housing market conditions. These super high prices were indicating an upcoming crash. Why do we say that? Because the world has seen a similar situation back in the 2000s. That's a whole other story, but we will only consider what's going on today by still keeping the previous recessions in perspective. A comprehensive chart we will see now is the Case-Shiller Index, filtered by year-over-year change. This graph before you provides insight into the rate of change in home prices compared to the past year. It gives us information for the past 35 years and even highlights the times when the country went through recessions. This can be a useful metric for tracking the overall trend in the housing market. For example, if the year-over-year change in the index is 5%, this would mean that home prices have increased by 5% over the past year in the metropolitan area covered by the index. A negative year-over-year change of -2% would indicate that home prices have decreased by 2% over the past year. You'll notice how an upward trend is followed by a drop, and this has happened throughout the 35-year period that's shown. This first price drop happened in the 90s. Although the trend began in the late 80s, it only went negative 2 years later in 1990. This time period is infamous because, in places like Los Angeles, home values doubled from 1984 up until 1990. But soon after, there were cuts to the U.S. defense and military spending after the Cold War, and that's why it badly impacted the local LA economy. There were massive job losses, and the housing bubble turned into a housing crash. People had no other option to gain money than to sell off their homes and move to more economic states like Arizona and Nevada. This 90s era saw a price drop of over 20% and bottomed out in 1996. But you'll hardly ever hear anyone talking about it. It's mostly the forgotten housing crash. Moving on, the market entered a golden age of slow but steady recovery. Jobs started coming back, the economy strengthened, and home prices started to go up. This recovery took 13 years, and then greed took over. Sometime into the early 2000s, it was pure greed that played its way into the housing market. Everybody, including speculators, investors, builders, and agents, drank from this pool of enormous profits. Prices went up to unnatural heights and became a part of the fuel for the upcoming Great Recession that showed itself in 2005. Now, why this recession happened is another long story. Many factors were involved, including a surge in subprime lending, declining home values, and a wave of mortgage defaults. Many borrowers were unable to keep up with their mortgage payments, leading to a wave of foreclosures that had a ripple effect throughout the U.S. economy. The resulting financial crisis had far-reaching consequences, including job losses, bank failures, and a prolonged recession. This crash period saw a negative index from the summer of 2007 till the summer of 2012. This 5 to 7 year period had massive consequences on the overall U.S. housing market. Nobody even thought about investing or jumping into the real estate market. It wasn't until May of 2012 that the market emerged from the depths of a negative price index and took the momentum of recovering. Slowly but surely, the trust in the housing market was building, and with social media promoting new ways of earning profits from this growing market starting to gain popularity, everybody saw an easy opportunity to gain wealth and jumped straight in. Now, what followed was greed yet again. This time around, the prices started to increase at a much faster rate thanks to the pandemic, and people who wanted to buy homes started to question whether they would even be able to afford a house or not. At some point in March 2022, the prices peaked at a 20% year-over-year growth rate after a near vertical climb, which is a never-before-seen point in the 35-year history. Now, as more and more people were out of the home affordability zone, prices started to drop from May 2022. This decline in the prices is in part driven by the higher mortgage rates hitting general housing affordability. In fact, home sales fell about 34% in 1 year from December 2021 to December 2022. So the big question is, are we already seeing the initial phase of a recession? If we compare it to what has happened in the past, the signs are all here. But one thing different is that there is not much inventory to fuel the decrease in the housing prices. This means there aren't enough homes on the market for sale like before. Plus, the lending criteria have also improved, making it harder for people to get loans approved. Only those who are capable of paying for their mortgage payments can get their hands on home loans, which wasn't the case in the 2000s market crash. Now, as we have already talked about how some cities are hit harder than others, take Phoenix and Las Vegas. And when we compare them with the National Home Price Index, both cities show a further sharper climb and drop as compared to the national index during the 2008 crisis. As the U.S. is large and some areas are more desirable than others, the decline of the housing market differs from the East Coast to the West Coast. But why? One key factor is supply and demand. The West Coast is a highly desirable location, but with the leading price surge, it's becoming less and less affordable, so people are fleeing these states. In contrast, the Midwest and East Coast have a more stable balance of supply and demand. Take a look at this chart now, comparing the home price index of a few East Coast, West, and Midwest cities. The difference is clear. The decline, which started in June of last year, isn't as sharp in the case of New York and Chicago as it is for LA and San Francisco. In fact, San Francisco has seen a 10% decrease in pricing in just a couple of months. This shows that the areas witnessing major price drop are located exclusively on the West Coast. So is the rest of the country going to follow suit and see a similar decline in price as the West Coast? It seems so, depending on the inventory levels. Because if history has taught us anything, and we're talking about the 2000s market crash, is that it's only a matter of time before the East Coast and Midwest show a similar but less intense pattern like the hard-hit West Coast cities. If you liked this video, we're sure you'll like other informative videos on our channel as well, so do check them out. Please hit that like button if you haven't already and subscribe to our channel for more amazing content. And in the end, thanks for watching.